Right now, millions of Chinese citizens are waking up to a nightmare they never saw coming. They check their banking apps, they rush to ATMs, they flood into bank branches, and they're all met with the same devastating reality. Their money is gone, locked away, frozen without warning. This isn't some distant economic theory or a problem happening to someone else. This is happening right now, and the panic spreading across China could signal something far bigger than anyone wants to admit. Before we dive deep into this crisis, hit that subscribe button and drop a comment below telling us if you've ever worried about your own bank account security, because what's happening in China might be closer to home than you think. The streets outside rural banks in Henan province tell a story that the Chinese government desperately wants to silence. Thousands of ordinary people, many of them elderly retirees who saved their entire lives, stand outside locked bank doors holding signs and demanding answers. These aren't political activists or troublemakers. These are farmers, teachers, small business owners, and grandparents who trusted the system with their life savings. Some of them deposited money just weeks ago, lured by the promise of higher interest rates than the big state banks were offering. Now they can't access a single yuan, and nobody is giving them straight answers about when or if they'll ever see their money again. The crisis began in April, when 4 rural banks in Henan province suddenly froze customer accounts, citing vague system upgrades and maintenance issues. At first, it seemed like a temporary technical glitch, the kind of thing that gets resolved in a few days. But days turned into weeks, and weeks turned into months, and still the accounts remained frozen. Behind the scenes, investigators were uncovering something far more sinister than a simple computer problem. These banks had been caught up in a massive fraud scheme involving fake loans, embezzlement, and corrupt bank officials who had siphoned off hundreds of millions of dollars. The money that ordinary depositors thought was safely sitting in their accounts had vanished into a black hole of financial crime. What makes this situation truly terrifying is the scale of the problem. Initial reports suggested around 400,000 depositors were affected, with approximately $6 billion locked up in frozen accounts. But as more information leaked out despite strict censorship, the numbers kept climbing. Some estimates now suggest over 1 million people have been unable to access their deposits. Think about that for a moment. 1 million families suddenly cut off from their savings, unable to pay rent, buy food, or cover medical expenses. For many of these people, the frozen money represents decades of careful savings, the fund they were counting on for retirement, their children's education, or emergencies. Now it's all gone, trapped behind a wall of bureaucratic excuses and government silence. The Chinese Communist Party's response to the protests reveals just how desperate the situation has become. When hundreds of depositors traveled to Zhengzhou, the capital of Henan province, to protest outside the provincial government buildings, they were met with a level of brutality that shocked even seasoned China watchers. Groups of men in white shirts, widely believed to be hired thugs working for local officials, violently attacked the protesters. Videos that briefly circulated on Chinese social media before being scrubbed by censors showed elderly people being beaten, protesters being dragged away by their hair, and crowds being dispersed with shocking force. The message was clear. The government viewed these depositors not as victims deserving help, but as threats to social stability that needed to be crushed. But the violence backfired in ways the authorities didn't anticipate. Instead of intimidating people into silence, the brutal crackdown only fueled more anger and drew international attention to China's banking crisis. Major financial outlets around the world began reporting on the frozen accounts, the protests, and the government's heavy-handed response. Suddenly, a problem that Beijing wanted to keep contained within Henan province became a global story about systemic weakness in China's financial system. And the more people looked, the more cracks they found in the facade of Chinese banking stability. The root causes of this crisis run much deeper than a few corrupt officials at rural banks. China's entire financial system is built on a foundation of debt, speculation, and government intervention that has created massive distortions in the economy. For decades, Chinese banks have been encouraged to lend freely to fuel economic growth, regardless of whether borrowers could actually repay the loans. This worked fine when the economy was growing at double-digit rates and property values were soaring, because even bad loans could be covered by rising asset prices. But now, with economic growth slowing to its lowest levels in decades and the property market in free fall, those bad loans are coming home to roost. Small, rural banks, which lack the resources and government backing of the big state-owned banks, are getting crushed under the weight of non-performing loans and fraudulent activities. The problem isn't limited to Henan province either. Throughout 2024, dozens of small banks across China were quietly merged or taken over by larger institutions. In September 2024, 36 rural banks in Liaoning province were absorbed into a newly created Liaoning Rural Commercial Bank, a move widely seen as a government bailout to prevent a broader banking collapse. Official statistics show that China's major banks closed an average of 1 branch per day throughout 2024, a clear sign that the sector is under enormous pressure. State media tries to spin these closures as a strategic slimming down or modernization. But the reality is that banks are shutting branches because they're hemorrhaging money and can't sustain their current operations. The response from Chinese authorities has been a masterclass in too little, too late. After weeks of protests and growing unrest, regulators announced in July that customers with less than 50,000 yuan in their accounts would be refunded immediately. That sounds generous until you realize it's only about $7,500, barely enough to cover a few months of expenses for most families. Customers with larger balances were told they would have to wait, with no clear timeline for when they might see their money. Even worse, the repayment plan came with exclusions that seemed designed to deny payments to as many people as possible. Anyone who deposited funds through alternative channels, seeking higher interest rates, or anyone deemed to have violated unspecified laws and regulations would receive nothing. This vague language gave officials unlimited discretion to reject claims, leaving many depositors in limbo. The international community is watching China's banking crisis with growing alarm, because what happens in the world's second largest economy doesn't stay in China. Chinese banks hold trillions of dollars in assets and are deeply interconnected with global financial markets. If the crisis spreads from rural banks to larger institutions, it could trigger a contagion that ripples through Asia and beyond. Already, foreign investors are pulling money out of Chinese markets at record rates, spooked by signs of financial instability and frustrated by Beijing's opaque response to the crisis. The People's Bank of China has tried to reassure markets by injecting liquidity and lowering interest rates. But these measures feel more like desperate attempts to plug holes in a sinking ship than solutions to the underlying problems. What makes this situation even more precarious is the collapse of China's property market, which represents roughly 70% of household wealth in the country. Major real estate developers like Evergrande and Country Garden have defaulted on billions in debt, leaving millions of homebuyers stuck with unfinished apartments they've already paid for. These homebuyers took out mortgages from the same banks that are now freezing accounts, creating a vicious cycle of financial distress. People can't access their savings to make mortgage payments. Banks can't collect on loans, and the whole system is grinding toward paralysis. Some desperate homebuyers have organized mortgage strikes, refusing to pay for apartments that may never be completed, which only adds more pressure to already fragile bank balance sheets. The social contract between the Chinese government and its people is fracturing in real time. For decades, ordinary Chinese citizens accepted limits on their political freedom in exchange for steadily rising living standards and economic opportunity. The Communist Party's legitimacy rested on its ability to deliver prosperity and stability. But now, people are watching their life savings disappear, their property investments collapse, and their future prospects dim. All while government officials offer nothing but censorship, violence, and empty promises. The frustration is palpable, not just among the relatively small number of protesters brave enough to demonstrate publicly, but among millions of others who are scared, angry, and losing faith in the system. The government's attempts to control information about the banking crisis reveal just how seriously they take the threat to social stability. Social media posts about frozen accounts are deleted within minutes. Journalists trying to cover the protests are harassed and blocked. Depositors who organize online or speak to foreign media find themselves visited by police and warned to stay quiet. Even the health code system that China implemented during the pandemic, which assigns people red, yellow, or green status based on COVID exposure, was weaponized against protesters. Several depositors reported that their health codes mysteriously turned red just before planned protests, effectively placing them under lockdown and preventing them from traveling to demonstrate. This creative abuse of public health tools for political purposes shows the lengths to which authorities will go to suppress dissent. Behind the scenes, Chinese regulators are scrambling to prevent the crisis from spreading. They've ordered the country's largest banks to provide financial support to struggling smaller institutions. They've launched criminal investigations into the officials and executives responsible for the fraud at the Henan banks. They've even set up special teams to process repayment claims and try to restore some public confidence. But all of these measures are reactive, addressing symptoms rather than the underlying disease. The fundamental problems of excessive debt, moral hazard, and lack of transparency in Chinese banking remain unresolved. Until those issues are confronted honestly, which would require admitting the extent of the problems and accepting short-term pain for long-term stability, the risk of further bank runs and financial instability will continue to grow. The parallels to historical financial crises are impossible to ignore. In the United States, during the Great Depression, thousands of banks failed and depositors lost their savings before the government implemented deposit insurance and stronger regulations. Japan's banking crisis in the 1990s, triggered by the collapse of a property bubble, led to decades of economic stagnation that the country is still struggling to overcome. The 2008 global financial crisis started with problems in American mortgage markets, but quickly spread worldwide, causing trillions in losses and throwing millions out of work. China's current banking troubles have the potential to be just as devastating, not only for Chinese citizens, but for the interconnected global economy that depends on Chinese stability. What can ordinary people learn from China's banking crisis? First, diversification matters. Don't keep all your savings in one institution, especially if that institution is offering returns that seem too good to be true. Higher interest rates often come with higher risks, and in China's case, those risks materialized in the worst possible way. Second, pay attention to the health of your financial institutions. Are they well capitalized? Are they properly regulated? Do they have the backing to survive a crisis? Third, understand that government guarantees have limits. Even though China has deposit insurance in theory, the actual process of getting compensated has proven to be slow, partial, and fraught with exclusions. The same could be true in other countries if a severe enough crisis hits. The crisis also raises profound questions about the Chinese economic model itself. For years, China's rapid growth was held up as proof that state-directed capitalism could outperform Western free markets. Government officials pointed to their ability to mobilize resources, direct investment, and maintain stability as advantages over the messy inefficiency of democratic economies. But the banking crisis reveals the dark side of that model: lack of transparency, corruption enabled by political connections, and the willingness to sacrifice individual rights for perceived collective stability. When the system works, everyone benefits from growth. But when it fails, ordinary citizens have no recourse. No independent courts to turn to, no free press to publicize their grievances, and no political process to hold officials accountable. As this crisis continues to unfold, the world is watching to see whether China can contain the damage or whether this is the beginning of a larger financial reckoning. Some analysts believe the government has enough resources and political will to bail out failing banks and prevent a systemic collapse. Others worry that the problems are too deep and too widespread for even China's powerful state machinery to manage. The truth probably lies somewhere in between. China will likely avoid an outright financial collapse, but the cost of doing so will be enormous. Taxpayers will bear the burden of bank bailouts, economic growth will slow further as credit tightens, and public trust in financial institutions will remain damaged for years to come. The human cost of this crisis cannot be measured in dollars and yuan alone. Behind every frozen account is a family facing real hardship. Retirees who can't afford medical treatment, parents who can't pay school fees, small business owners who can't make payroll. These aren't abstract statistics or theoretical economic indicators. They're real people whose lives have been upended by a crisis they didn't create and couldn't prevent. Some of them will never recover financially. Others will carry the psychological scars of watching their life savings disappear and being beaten by thugs when they dared to ask for help. This is the human reality of financial crisis, and it's playing out across China right now, while the government pretends everything is under control. So what happens next? In the short term, expect more bank mergers, more government interventions, and continued efforts to suppress information about the scope of the problems. Chinese authorities will do whatever it takes to prevent the crisis from becoming a full-blown panic that threatens the political system. But the underlying tensions will remain. The debt bubble hasn't popped. It's just been inflated a little more. The property crisis hasn't been resolved. It's been papered over with half measures. And most importantly, the loss of public trust hasn't been repaired. Because you can't rebuild trust with censorship and violence. At some point, possibly years from now, China will have to confront these fundamental imbalances. The only question is whether the reckoning comes in the form of managed adjustment or catastrophic collapse. For the millions of Chinese citizens whose money is frozen right now, that question isn't academic. It's everything.